Good afternoon, and welcome to Sensible Financial's webinar on mutual fund distributions and what they mean for you. I'm Rick Miller, Sensible Financial's founder and CEO, and I will be your moderator. Today, Sensible Financial Senior Advisor and Senior Director of Strategy, Chris Andrysiak, will talk about mutual fund distributions, how they are calculated, and what they mean for you. Chris is a certified financial planner and holds a Master of Business Administration degree from Tuck School of Business at Dartmouth College. He's been at Sensible Financial since 2017. Please submit your questions through the Q&A link at the bottom of your window. Chris will answer as many questions as he has time for, once approximately midway through the webinar and once at the end. Unfortunately, he can't give personal advice in this setting. There isn't time to gather the information and context necessary to do so. We will provide contact information for Chris at the conclusion of the webinar, and we will be sending you a link to the recording as well. Take it away, Chris.
Great. Thanks, Rick. And hello to everybody. Good afternoon. Thank you for joining us. We're going to talk about something that happens this time of year, which is mutual fund distributions. And what are they? How do they work? And what impact do they have on you? And what, if anything, should you do about them? Now, just to kind of make sure that everybody is starting from the same level of knowledge, we're going to start at the very beginning in terms of some real basics around how mutual funds work. But I hope that whether you are a knowledgeable mutual fund investor or just starting to build your knowledge, that there will be something for you over the next little while. All right, so first, just a reminder of what a mutual fund is. Right? A mutual fund is a company. And that company, their business is to buy other types of investments for their customers, their shareholders, their clients, and hopefully make a good return on the investments that they make within the mutual fund. So here's a little schematic of a simplified mutual fund. We're going to be creative and call it the XYZ mutual fund. And this particular mutual fund holds shares in 5 different companies: Coca-Cola, Home Depot, Apple, General Motors, and Microsoft. The mutual fund also has some cash. So again, this company called a mutual fund holds shares in each of these companies and a little bit of cash. In this hypothetical mutual fund, there are 1,000 shares. So the value of the company, the earnings of the company are divided 1,000 ways and split up between the shareholders in that fund. Now, a real mutual fund probably wouldn't hold just 5 stocks. It might hold 50 or 100 or 300 or 500 even. A real mutual fund also would have many more than 1,000 shares. But just to make the examples that we're going to use easy, we're going to use this. All right. So I want to start with something called the net asset value, and that is that's essentially the price of a mutual fund. And I want to talk about how that is calculated, because that's an important building block for what we want to talk about as we go forward. So within our mutual fund, as you'll recall, we've got shares of Coca-Cola. And it turns out that within this mutual fund, the fund owns 100 shares of Coca-Cola. Those shares are valued at $61.14 per share. And so 100 shares is $6,114 of value. Now, the mutual fund also owns shares in these other companies that we looked at before: Home Depot, Apple, General Motors, and so forth. And it has some cash. If you do the addition and you sum it at the bottom there, you'll see that the total value of that mutual fund, the investments within it, including the cash, is $62,044.25. That's something called the net asset value, or NAV, of the fund. And we're going to be talking about that NAV quite a bit over the next little while here. But that's the total NAV. We usually then divide it by the number of shares that are outstanding for the mutual fund. And because we have 1,000 shares outstanding for the mutual fund right now, the net asset value, or NAV, per share is $62.04. And that's the price per share that you pay for the mutual fund. All right. Now, let's look at a couple of the core things that mutual funds do as part of their business for their investors. One of the things they do, because they own shares of all these stocks, is they receive dividends, right? So stocks, companies pay out portions of their earnings to their shareholders. And because the mutual fund is a shareholder in these companies like Coca-Cola, the mutual fund is going to receive the dividend. So in this example, Coca-Cola is paying out a dividend of 44 cents per share. Now, the mutual fund, as we saw earlier, owns 100 shares of Coca-Cola. So 44 cents per share times 100, the mutual fund is going to receive a check from Coca-Cola for $44. Now, it already had $1,000 of cash, so now it has $1,044 of cash. It's that simple. And with that cash, the mutual fund manager decides what he or she wants to do with that cash. So that's one of the core things that mutual funds do, is collect those dividends throughout the year. And in our simple example here, it's one stock is paying a dividend and they've done it once here. But in a real mutual fund, there's usually, as I said before, hundreds of stocks that are owned. And so there are hundreds and thousands of dividends that are coming in throughout the year. A second thing that the mutual fund does is they are buying and selling shares of these stocks that are within the fund as they go through the year. So let's look at an example of that. So let's start off with the funds here and the holdings that we've been using. And let's say that the manager of the mutual fund decided that he or she no longer wanted to own General Motors shares for the fund. They think that General Motors is going to be a poor investment. And instead, they decide that they want to own shares of Tesla. So here's the transaction they do. They sell their 75 shares of General Motors, and then with that money that they get, they buy as much Tesla as they can, which happens to be 17 shares. And they'd have a little bit of money, a little bit of cash left over. So they'd get 17 shares of Tesla, and they'd have $103.63 remaining. So we can look at some of the lines on the page here and see what's happened. So we've got General Motors here, that is no longer in the fund. Tesla is now in the fund. You can see the values are similar, but not exact. And that's just because they're buying a certain number of shares and the prices of the two companies are different. And so there's a little bit of cash left over. And you see that the cash on this line went from $1,044 to $1,147.63. So the extra one in here. But if you look at the bottom of the page, the numbers are the same. The net asset value is $62,088.25, both before and after. So the value of the fund did not change because it exchanged two assets of equal value. Before the transaction, it had General Motors stock. After the transaction, it had Tesla stock plus a little bit of cash, but it all added up to the same amount. All right. So now that we've talked a little bit about the basic operations of a mutual fund, let's talk a little bit about distributions, the primary topic that we're going to get to today. All right, so mutual funds are regulated under legislation called the Investment Company Act of 1940. That was the legislation that created the legal structure that allows mutual funds to exist. Now, mutual funds do not pay tax at the entity level. So that means that a mutual fund company does not pay tax. Rather, they pass on, and they must pass on at least 98% of their income every year to their shareholders. This type of entity is called a pass-through entity. So they pass their income on to their shareholders at least annually, and then whatever tax is due on that income gets paid by the shareholders. So you know that the IRS wants to collect tax on the income. It's just that they choose not to do it at the level of the mutual fund, but rather the level of the shareholders that own that mutual fund. All right, so now let's talk a little bit about how that works. All right, let's look at the sale of General Motors, which we talked about a few minutes ago. So when the mutual fund sold its shares of General Motors, they sold it for $39.77 per share. Now, it turns out that they had purchased the shares for $30.02 back in 2020. So they made a profit, a gain of $9.75 per share. And the mutual fund owned 75 shares of General Motors. So the profit that they made, the gain, you do the multiplication there, is $731.25. Now, the mutual fund has to keep track of that, and we're going to see why in just a moment. All right, now at the end of the year, the mutual fund manager or the company totals all of the dividends and all of the gains and losses that they received during the year. So we go back and we saw the gain on the General Motors shares. We saw the dividend that came in on Coca-Cola. They add that all up for the year. And then what they do is they divide it by the number of shares in the fund. And in this case, we have 1,000 shares. And then each investor, each shareholder in that fund is going to receive a payment called a distribution, which equals the amount of those gains plus the income, the dividends that the mutual fund received, divided by the number of shares in the fund, and then multiply that times the number of shares that they own. So let's go through a real life example of that here. And while we do that, we're going to see something that is very interesting that occurs when a distribution is paid out. So let's again go back to our example. Before paying out the distribution, this is again what we have. We've got the Coca-Cola, the Home Depot, we now have the Tesla and so forth. And we had the NAV, net asset value total of 62,000, and then we divide by the number of shares and we have an NAV per share of $62.09. All right, so that's all review of what we have shown on previous pages. Now let's go to the dividend and the capital gain that the fund received during the year. And again, this is a simplified example with one dividend and one capital gain that it realized during the year. A real fund would have thousands of those things. But if you add up the $44 dividend and the capital gain of $731, you come up with $775. All right, and divide by 1,000 with a little rounding, you come out with 78 cents per share. So here's what happens. The mutual fund had $1,147 of cash, but it pays out $775.25 in a dividend. And when it does that, the cash therefore is reduced. So now it has about $372 in cash within the fund. Now, if we add up all the assets in the fund, and just for this very simple example, the shares of the fund have not changed, the cash is down, so of course the total is down. So now we have $61,313 of NAV in the fund. You divide by 1,000, and now your NAV, your price per share, is only $61.31. So the price of the fund has gone down. Now, many people might look at that and say, well, that's not what I want. I want the price to go up, not go down. So I must not be as well off as I was previously. But it's not quite that straightforward, because if we look at the 78 cents per share that the investor received in that dividend, and we add it to the 61.31 that is the new value of the fund, it adds up to the 62.09, which is exactly what it was before. So the investor, in some sense, is in exactly the same spot they were before. They still own the same number of shares of the fund. It's just that the shares of the fund are worth a little bit less money, but they have more money in their pocket. And if you add it all up, it's the same. So they should be indifferent to this, right? Or maybe not. Let's see. Well, it depends. So if a mutual fund is held in a retirement account, like a 401k or an IRA, those are common examples, there are others, they are really indifferent to that distribution because taxes are deferred, and importantly, because all income received by an investor in one of those types of accounts is taxed in the same way. when it's eventually pulled out of the account years down the road, probably. It's all taxed the same. However, if the mutual fund is held in a non-retirement account, so just a regular old, we call it a taxable brokerage account, then the distributions are taxed for that tax year. And some of them, like dividends, are taxed at ordinary income tax rates. Others are taxed at capital gains tax rates. But the key point is that the taxes are paid are due for that year. So they're probably paid the next April, as opposed to being paid down the road. So the difference then really has to do with what type of an account the investment is owned in. Those investors that are in those non-retirement accounts, so not the IRA, not the 401k, they will have received a taxable distribution, even though the value of their total investment has not increased. So again, we go back to that example. At the end of the day, they had $62.09, both before and after, yet now they have a tax that they have to pay for this year because they have received that distribution. So that's one of the things that can be a little bit difficult for investors related to these distributions. Okay. Now, many investors, we're going to talk about one other thing that can be a little counterintuitive here. And many investors choose to do something called reinvest their dividends. So let's look at what that is and how that works. Let's go back again to that same example. We've got dividends of $44, capital gain of $731.25. We come out with 78 cents per share is the dividend distribution. And let's just say that we're a hypothetical example or investor investing in this hypothetical fund. And we own 100 shares of that fund. So there's 1,000 shares of the fund, right? And we own 100 of them, right? So 78 cents per share in distribution, and we own 100, so 100 times 78 cents, we get a check for $78. We're going to get a dividend distribution of $78. Now, let's go back again to the list of investments in that fund, and after paying out that distribution, you'll recall that the share price, the NAV per share, had dropped to $61.31, right? So you can set it up with the mutual fund company so that you take that $78 that you received, that you would have received as a check, and rather than receiving it as a check, you can actually just set it up so that you automatically buy more shares of the fund. And in this case, we have $78. The price of the fund is $61.31. So you could buy 1.27 more shares of the fund, right? And many investors set things up to do exactly that. And so they never really see that dividend. And it's something that can be a little, a little perplexing. People don't really remember that that's how they set up the mutual fund when they first purchased it, to reinvest dividends. And what really ends up happening is that they received a dividend, even though they didn't realize it. They're going to be taxed on it. They didn't receive any cash. The thing that they're forgetting about is that they now own a few more shares of that fund. In this example, they own 1.274 shares of that fund. And so if they didn't open their statement and go look at it carefully and realize they had slightly more shares, they say, all right, I have to pay tax on something here. I got this distribution, supposedly. Yeah, I didn't get any more cash in my pocket. That doesn't seem right to me. So these are the two of the things that can be a little bit confusing about mutual fund distributions. This is just the way the mutual funds are set up. Now, you don't have to reinvest those dividends. If you want to feel like you are really receiving the benefit of those dividends, sometimes it can be better to actually receive a check or have the dividend deposited into your account, because then you'll actually see the money, right? And then somehow it doesn't feel quite as bad to pay tax on it if you've actually gotten that check. Now, professional investors like Sensible Financial, when we're investing for our clients, we tend not to reinvest those dividends because we take that cash that comes in and use it to rebalance the account. So if if a certain fund is a little lower than it should be, or a little, yeah, if it's a little lower, then we might take that cash rather than reinvesting it in the fund that paid out the distribution. We would use that to buy a few more shares of whatever asset class might be a little low, because we're trying to keep our clients' accounts and portfolios right on the target asset allocation that has been selected. Okay, now let's look at one other confusing situation that can happen, and it's actually happening this year. All right, so as we saw before, we had our General Motors, the sale of General Motors, right? And we bought Tesla. And this is before the distribution happens. And we saw that the NAV per share stays the same, 62.09, right? But we know that there was a gain there that is going to eventually, later in the year, lead to a distribution that will be taxed, right? Now, before the end of the year, something happens, which is kind of like what happened this year, which is there's a market decline. In this hypothetical example, we're going to call it a 10% market decline. So all of the stocks in our example have declined in value by 10%. So you add them up, the cash, of course, stayed the same because it's not stock, it's cash. And you divide by 1,000, and suddenly the NAV per share, the price per share of the fund, is less than it was before, right? $55.88 per share. Before it was 62.09, right? And we've all experienced this. The market goes up, the market goes down. The value per share of these investments goes up, it goes down. That's kind of part of investing, right? But it can lead to this sort of uncomfortable situation where during the year there were profits realized within the fund. There were dividends that were paid. Yet, and so those have to be paid out as distributions. They will be taxable. So the investor received something that is taxable, yet the value of their investment has gone down because of this market decline. So, it makes sense. The company, the mutual fund, made some profits on something during the year. The government needs the mutual fund or its investors to pay tax on that, but the value of that investment has gone down. And that's exactly the sort of thing that has happened this year. Mutual funds are largely down this year, given what's going on in the markets, yet there are distributions being paid out about this time of year. All right. So with that, we are going to take a pause at this point, at sort of the halfway point, before we get into, okay, so what does this all mean and what can you do about it? And we have time for a few questions right now, and I'm going to turn it back over to Rick to let me know what the questions are.
Okay, Chris, we do have some questions. The first one is, do I have any option on receiving this taxable income?
No, you don't. Easy answer. The answer is not. No, if you own shares of the fund, you have to take these dividends that are paid out. It's just a natural consequence of the structure, the mutual fund structure. So they are sent out to you.
Okay. One of our attendees would like to know if they've set up their distributions to automatically invest, how quickly does that reinvestment transaction take place? Does it happen immediately after the distribution?
Yeah, I think that it happens immediately. I think it happens on the day of the distribution at that day's net asset value. I'm fairly sure that's how it happens at the various mutual fund companies.
Okay. You talked about mutual funds distributing dividend income and capital gains, and but some of them are some distributions, some dividends are taxed differently than others, right? If I get interest income, that's taxed as ordinary income, and if I get what's called qualified dividend income, then that's taxed as qualified income, right? But the example that you showed had just one distribution. How do I divide that distribution for tax purposes?
Right. Yeah. No, that's a great question. And these examples that I put on the screen are simplified examples. You know, like I said, real mutual funds don't have 5 stock holdings; they have, you know, maybe 500. And that's another example of a simplification I used here, which is that I really only used one type of dividend and one type of capital gain. But there are different types, and they have different types of taxation. So for instance, there are, and I'm not going to get into the details of taxation, that's sort of outside the scope of this webinar, but when you receive these distributions, they will be characterized by the mutual fund according to the type of income it is. So you might get a long-term capital gains distribution, or you might get a short-term capital gains distribution, and those are taxed differently. And they will be characterized that way by the mutual fund company. So if you look at your statement at the end of the month, and you see that money was added to your account, either you received cash or it was reinvested, it'll say on the line item underneath the transaction, short-term capital gain distribution, long-term capital gain distribution. The same thing for the different types of income. There's something called a qualified dividend, which essentially means that those are from companies that have been held more than a certain amount of time within the mutual fund, and so those dividends are taxed differently than other dividends. Again, I'm not going to get into the detail of that today, but all of that will be specified by the mutual fund company when those distributions are made.
Okay. And how do I find out my distributions so that I can prepare my tax return?
That's a good question, and we're going to get to that a little bit in the second half of the session. But let me give you part of the answer, which is the part of the answer that pertains to what happens, say, in January or February, so that you can prepare those tax returns. And you will get a statement from either from your brokerage firm or from, if you're investing directly from a mutual fund company, then they would send a statement to you, and they will tell you what those distributions are. And that's on a form that the mutual fund company typically files with the IRS as well. The brokerage company does. And then you need to, your accountant, or you, if you're doing your own taxes, needs to take that information and enter it on your tax return. So they are required to provide you those types of statements. And most mutual fund companies and brokerage firms do that in late January, maybe early February.
Okay. And I think perhaps we have time for one last question before we go to the second part of the webinar. What about ETFs? How do the distributions work for ETFs?
Okay, we are going to talk later about ETFs and a little bit about how they're slightly different than other types of mutual funds, but at a high level, the distributions work the same way, and so they send out distributions in the same way. An ETF is a type of mutual fund. It's governed under much the same legislation, but there are some differences, and a really important one on this topic, which we will get to. But at a high level, it functions the same way.
Okay, and we have one last question. What if I sell my fund before they send the distribution? Do I still get it? Do I still owe tax?
Yeah, that's another very good question. So the answer is no. There is a day when the dividend is paid out. There's actually a day called the ex-dividend date. And if you own shares of the fund on that date, then you will receive the dividend, and it usually comes a couple days later, 2-3 days later. So if you've sold your shares before that distribution, then yeah, you do not get that dividend. Do not get that dividend. You have to own it on the ex-dividend date, and you can, if you bought the fund a day before the ex-dividend date, then you would own that fund and you would get that distribution, that share of the income for the year, even though you only held the fund for 1 day or so. I'm going to talk more about that in the second half of our session, because there's something that you can potentially do about that if you are so inclined.
Okay, great. Let's move on, Chris.
Okay, good. All right, so we have now talked about some of the mechanics of how these things work. Let's talk about what you can or should do about it. Now, one of the most important things that you can do is use this information to buy the right kind of mutual fund. And here I'm mainly talking about taxable accounts here, but there are two types of mutual funds really. Actively managed funds, which are ones where the fund manager buys and sells stocks based on their assessment of future cash flows and changes in market value. Our example of GM and Tesla earlier is a good example of that. The fund manager decided that GM was not going to be a good investment going forward and would rather own Tesla shares, and so they made that change. And these types of funds, actively managed funds, typically have a lot of buying and selling. That's what you are hiring the fund manager to do. So when they buy and sell a lot, they tend to have a lot of capital gains or maybe capital losses. A passively managed fund, and an index fund is a good example of that type of fund. They do buy and sell, but the fund manager is basically an algorithm. They are buying and selling just to maintain each stock's respective weight in the market. So if Microsoft is 3.1% of the index, then the manager is doing whatever they have to do to keep Microsoft at 3.1% of the value of that fund. And if Microsoft goes up to 3.2%, then the manager needs to buy a little bit more to keep it at 3.2%. But what they are not doing is they're not saying, we're done with Microsoft, we're going to sell the Microsoft shares and sell it all. They're just buying or selling little bits. And as a result, that means much less buying and selling. And the buying and selling that does occur is just small adjustments. Right now, we can see that by a metric that mutual funds publish. And that is something called the turnover ratio. So the turnover ratio is the percentage of a mutual fund's holdings that have been replaced in a given year. So going back to our hypothetical example, well, we won't use that one exactly, but if there were 5 holdings within a fund and they were all equal value so that each one was 20%, and the manager replaced one of those funds or one of those stocks with something else during the year, then that would be a 20% turnover ratio. 20% of the fund's holdings had been turned over. That's how they calculate turnover ratio. Here's the turnover ratio for the 5 largest actively managed mutual funds and the 5 largest index funds. And if you look at the numbers here, you'll notice that the turnover ratio for the actively managed funds is considerably higher than the turnover ratio for the index funds. So that's very consistent with what I just said. The index funds are making small adjustments within the portfolio, but they're not making big buys and sells. Whereas the actively managed funds, that's what they are doing. And in fact, the funds that are these very large ones that are on the page are for actively managed funds are actually fairly low. There are lots of actively managed funds that have turnover ratios above 50% and even above 100%. So a turnover ratio of 100% would mean that all of the holdings within the fund had changed from one year to the next. And you do see that, right? So when you see all that change, all that trading, all that turnover, then that means that there are probably gains to be distributed to the shareholders. And those gains are going to be taxable distributions if it's held in a taxable account, not an IRA, right? Not a 401k. And so the investor is going to end up paying tax on those distributions as a result of the high level of trading. And there's actually a metric on that Morningstar calculates. It's an estimate. They call it the tax cost ratio. And that measures how much of a mutual fund's annualized return is reduced by taxes that investors pay on distributions. Now, it's an estimate, okay? Because of course, it depends on what is the tax rate for the investor and so forth. And again, this does not apply to funds that are held within IRAs or 401ks. But the tax cost ratio, again, you see here, when we compare those same funds, the tax cost ratio is much higher for these actively managed funds than for the index funds. And so this is a sort of a concrete way of demonstrating that the index funds are much more tax efficient, meaning that they don't lose as much of their return to taxes as the actively managed funds do each year. And that's a big part of why many people are using a lot of index funds these days, and certainly why Sensible Financial uses a lot of passively managed funds. Is just when we think about the returns in your pocket, so after tax, the actively managed funds have this tax drag, plus they tend to have higher fees as well. So the manager of those actively managed funds, they have to do really well to beat the index funds, because they've got to sort of outrun the taxes and they got to outrun the higher fees. And that's hard to do. And if you look at the data, most of the actively managed funds do not outrun the index funds. All right. Let's now talk about ETFs. Somebody asked a question earlier about ETFs. So an ETF is an exchange traded fund, and most exchange traded funds are index funds. There are now some actively managed funds, and that's a relatively new structure, but for the most part, they are index funds. And it turns out that they are even more efficient, even more tax efficient than standard mutual funds. So one of the reasons for that is that, and I'm not going to go into a lot of the detail here, we'd have to have a much longer webinar to go through this, but the way that investors either buy or sell shares of a mutual fund is a standard mutual fund is different than an ETF. And as a result of that, the ETF does not need to do as much buying and selling within the fund as the mutual fund does. So just in the course of everyday business, the ETF doesn't need to trade as much as the regular mutual fund does. And so therefore there are fewer gains to distribute. It's also true that there's a loophole in the tax code that allows the ETF sponsors to eliminate most of the capital gains within the ETF. And again, it's very complicated. We're not going to go into it here, but if an ETF does have capital gains within it from buying and selling and making a profit on the investments, they're able to make those gains go away. They just disappear. And so if they disappear, they don't need to distribute them. And that's exactly what happens is you see that ETFs very rarely have capital gains distributions. They may have distributions of dividends, and you can't really avoid those, and you want them, I guess. But the capital gains, they can make those go away, and they do. So you almost never see distributions, capital gains distributions from ETFs. So bottom line, index funds are already very tax efficient, and an ETF is even more so. And so when you ask the question of understanding distributions, what can I do about it? Well, one of the biggest things you can do about it is to buy index funds or even ETFs rather than actively managed funds. And that's certainly what Sensible Financial does for its clients. All right, let's go on to another thing that you can do. So about this time of year, actually usually late November, mutual fund companies publish estimates for what their distributions are going to be before the end of the year. And they can't tell you exactly what the number is because they don't know what's going to happen for the rest of the year. They may have to buy and sell a lot, but they have a pretty good sense of where they are at 11 months into the year. And as a result, they can let their shareholders know that we're going to distribute this amount per share roughly. And it might change a little bit, but and so all the mutual fund companies do that. They make that information available. And so you won't necessarily be surprised when you get those distributions because they've provided that information for you, and you can get it on the mutual fund companies' websites. And financial advisors like Sensible, we've got that information, and we use it to help advise our clients. So let's talk about what you can do if you've got that information and the sort of thing that we and probably other advisors are doing. Here's an example. Let's just say through the end of November, a hypothetical investor owns two mutual funds, the ABC mutual fund and the XYZ mutual fund. And they know that they have losses that they have realized throughout the year of $9,400, right up here at the top. And that's because maybe they sold some shares in the fund during the summer because they were going to, buy a car or whatever, and the market was down or that fund was down, and so they have some losses, right? So they're sitting here at the end of November. They've got $9,400 of losses at this point in the year. Well, they look at the distribution estimates that the mutual fund companies provide, and they see that they should expect to receive $3,500 in long-term capital gains distributions before the end of the year. Right? So they look at these two numbers, and you can net them against each other. They say, okay, I've got losses. I'm going to have some gains that are distributed to me. So I do the math here, and I see that I'm going to be in a position where I will have long-term capital losses of $5,900 before the end of the year. So what do you do about that? So there's a couple of things you can do. First of all, you can just let the year finish and do nothing, and then you'll finish the year with $5,900 in capital losses. You can take up to $3,000 of that and use it to, as a deduction against your ordinary income. So against your salary and dividends, things like that. You can reduce that income, that taxable income, by $3,000, but you can only use the $3,000, no more than that. But then you can save the rest of them for future years. So in our example, there's $5,900. They use $3,000 against their income, so then there's $2,900 remaining that they can use next year somehow. Another possibility is maybe they say, I've got another investment that I really don't like. It's not as good of an investment as I like. Maybe there's a better option. But I've been reluctant to sell it because of the capital gain. Well, if that fund or that other investment, or it could be something else, could be a house that you sold or whatever, if there's a gain there of $5,900 and you've got a loss, then those two can offset each other as long as they occur during the same tax year, and you can end up with a zero capital gain at the end of the year. So there are a few things you can do here, and one of them is just do nothing, but another one is that you can be a little bit more proactive and try to manage what the tax bill is going to be for that year by managing those gains and losses that you will realize by the end of the year. And you can do that if you know what's coming. And because the information is provided, you can know what is coming. All right. Let's go on to another thing that you can do, and we don't always recommend this, and I'll tell you why. But we talked earlier about owning a fund on its ex-dividend date. So if we went back to the Fidelity page that I showed you on the screen a few minutes ago, not only was the estimated distribution listed, but also what's called the ex-dividend date. And that's the date when, if you own the fund on that day, then you will receive the dividend. Even if you sell the fund the next day, if you owned it on that day, the ex-dividend date, then you are going to get that distribution. All right. Now, here's the thing. If you buy that fund, let's just say the day before the ex-dividend date, then here's what's going to happen. You bought the fund. The next day, the NAV is going to fall. You're going to receive a taxable dividend equal, and that's going to be equal to the amount of the decline. So your overall situation will be the same, but you'll have a tax obligation. So essentially what happened is you just send money to the mutual fund to buy shares, and the next day they send you back a little bit of it with a tax bill attached to it. So that doesn't seem like a very good idea. Seems like you'd want to just wait. And maybe if it's the day before the ex-dividend date and you're ready to buy, maybe you want to wait, but what if it's a week before or a month before? Do you want to wait? And but here's our view on that, is that when you look at the data, the mutual fund, the stock market is really unpredictable. And you don't know on a day-to-day basis for sure what's going to happen. We also know that sometimes the big gains or big losses can happen in very concentrated periods of time. There's sort of spurts of growth sometimes. An example of that is we saw some research recently where they looked at 25 years of stock market returns in the US from 1997 for 25 years. And they looked at how much you would have at the end of that period if you had invested in that first day of 97 and let it run for 25 years. And if you had been out in the market, if you had not participated in the best week during that 25 years, your return would have been 19% lower just by missing out on 1 week, right? And so that really highlights, and that's an extreme example, but it highlights what can happen if you are waiting to make that investment. And chances are, if it's the day before the dividend or the distribution, chances are that you're not going to miss out. But if you wait a few days, a few weeks, what if that was the week when the big gain happened, right? And it certainly would not have been worth waiting for. We call that letting the tax tail wag the investment dog. So generally, we tend not to wait to invest when we have cash, even if we know that a distribution is coming up. And part of that, a big part of that, is because we are primarily investing in passively managed funds, which don't distribute very much. So it's okay for us to go ahead because we don't want to miss out on the big gain if it happens, and we're not predicting it will necessarily, but if it does, and the tax bill isn't going to be very large because the kind of funds that we invest in don't have those big distributions. Okay. The last idea to share before we close here has to do with something we call asset location. Understanding the kinds of distributions that are paid out and understanding some of the differences in how different things are taxed, you can decide to put certain types of investments in certain types of accounts. So many people have both taxable accounts and tax deferred accounts, with the tax deferred accounts being the retirement accounts, largely like 401ks and IRAs. So we tend to place equity or stock mutual funds in the taxable account because stocks are more likely to have higher increases in value and capital gains over time. And if they are in this taxable account, then they can benefit from the capital gains tax rate, which for many investors is lower than the ordinary income tax rate. Bonds we tend to put in the retirement accounts because the income is all taxed at the same rate. If you have a capital gain, it's still taxed at the same rate when you pull the money out down the road. And so you're really not benefiting from that capital gains tax rate that is lower for many people. In understanding the distributions and the type of distributions that are more likely to be generated from the various types of funds, you can be smart about where you put those investments, what types of accounts, and hopefully be a little more tax efficient that way. So those are the ideas that we have and that we think about from a tax perspective related to distribution. So let me just summarize what we have said here, and then there'll be some time for questions. So first of all, mutual fund distributions are a natural consequence of their structure. It's just baked into how mutual funds were created under the tax code. Now, in retirement accounts, investors should be indifferent to distributions. And in fact, many investors will just reinvest those dividends. And there's really no difference from a tax perspective. In non-retirement accounts, those distributions do create a taxable obligation. And like this year, that can happen even if the fund's value has declined. Mutual fund companies do provide advance notice of their likely distributions, and those are occurring, kind of right now or the last few weeks. So there are some things that investors can do. They can use passively managed funds like index funds and ETFs, which are more tax efficient than actively managed funds. They can make year-end buying and selling decisions to manage the tax bill. You can think about, but we urge people to be cautious about delaying investing in advance of a planned distribution, that buying a distribution or buying a tax bill concept. And then lastly, you can locate your equity investments in non-retirement accounts, knowing that you're more likely to get the capital gains distributions and benefit from the capital gains tax rate that is available in the non-retirement accounts, but not available in the retirement accounts. All right, so that brings to a close the prepared remarks and the presentation, and I think we have time for a few questions. So I'll ask Rick to come back on the line and see what we have.
Hey, Chris, and we do have some questions. Let me get organized here just a bit. Okay. So one person asks, you said that actively managed funds have higher costs, and John would like to know if the performance of actively managed funds compensates for those higher costs.
Right. Well, that's the idea, the claim of those managing the mutual funds is that they do such a great job of buying and selling and picking the right stocks that the returns outweigh the higher costs that you're paying, and by the way, outweigh the tax drag that would be associated with them in taxable accounts. And some of the actively managed funds definitely do that. But if you look at the data, the odds are against you, and most of them over longer periods of time especially do not. And that's true across almost every category of mutual funds. And if you look out, especially over 5 to 10 years, depending on the category, you get like 80% of the actively managed funds are underperforming their index. And a big part, it has nothing to do with that the managers aren't smart, hardworking, diligent people. It's just that they've got those taxes to outrun, and they've got the higher fees to outrun, and most of them don't.
Lawrence asks, you say that ETFs eliminate most capital gains within the ETF because of minimal trading and the other considerations that you mentioned, and that makes sense year to year. But what about the capital gains when you go to sell the ETF? You still pay tax on those at that point, right? Yep,
you do. That's right. And that's one of the complicated things about understanding all this, is that there are two levels of capital gains that we're talking about here. One of them is kind of within the fund. And that's the kind of thing that we looked at in the examples is the gain from selling the General Motors shares. And those have to get sent out from the fund to the shareholder. But it's also true that if you buy the shares of the fund for $62.09, like was our example, and if you sell it a few years later and it's $70, then yeah, there's a gain there, and you would pay capital gains on a tax on that gain. But the situation there is you can decide when you want to realize that gain by selling those shares, and that's the nice thing there, is you have control over it. The distributions within the fund, you don't have control of those. You're going to get them whether you want them or not. And if it's a bad year for you to get them, too bad, you're going to get them anyway. Whereas buying and selling the fund, you can kind of control that.
Another attendee would like to know, or asks, or asserts, in general, it seems that an investment advisor who invests in individual stocks and bonds would produce more tax efficient returns, as opposed to an investment advisor who invests in mutual funds, since the the first one has more control over buys and sells than the second one does. Can you
Yeah.
comment?
Yeah, absolutely. And this is something you hear commonly, that people say, you really shouldn't buy mutual funds because you're going to get these distributions and you have no control over them. Rather than buying, Coca-Cola and General Motors and Apple and the 5 companies that we had in our hypothetical fund through the funds, just buy them directly, and then you'll still get the dividends. But you can decide when you want to sell General Motors, as opposed to letting the portfolio manager do that. And that's all true. However, we think that for most investors, the diversification benefits and cost benefits and hassle benefits of buying mutual funds, we think that outweighs what you're talking about, which is the control over those distributions, and in particular, if you're talking about index funds that really, or ETFs that really distribute very little in the way of gains. And if you have a very, very large portfolio, you can get good diversification by buying your own stocks. But we find for most investors that we work with, that mutual funds and ETFs are a much more efficient way to get there, despite that little bit of lack of control in the taxable accounts over the distributions.
Another attendee asks about the Fidelity table that I don't know if they have the table that you showed or if they have their own copy, but they say that the distribution is shown as a percentage of NAV. How to calculate the estimated dollar amount of the distribution given the NAV, given that the NAV changes over time? Should I use the NAV on a particular date?
Right. So I believe that Fidelity table, or there is one available that also says the dollars per share. So it'll say, $2.19 per share. And then they will use that figure to calculate the percentage that you're citing. So, make it easy. If it's a $2 per share distribution and the NAV on the day of the distribution or the day when they're deciding upon it is $20, then that'd be a 10% distribution, which would be high, by the way. But I think that they do determine the distribution in dollar figures and then calculate the percentage. And I think that they use the ex-dividend date when they do that calculation.
Okay.
Right.
Someone else asks, if you have mutual funds in a retirement fund and are indifferent to the distributions you receive, it's unclear why you recommend just bonds in the retirement fund. Can you explain? And I think that there may be confusion about whether there are multiple accounts or just one account.
Yeah, so most investors are going to have both stock funds and bond funds, right? A diversified portfolio. And many investors are going to have both a retirement account and a non-retirement account. And so now, how you line those up against each other kind of depends on the relative size of each of those. But when we do this, we tend to put the investments that would have a higher expected return in those taxable accounts because they can benefit from that capital gains tax rate. But if you only have non-retirement accounts, if what you have is IRAs and 401ks, then you're going to put it all in those because you still want to have a diversified portfolio.
Right. Okay. I think, unfortunately, we are out of time. So I think we have to wrap.
Right. Well, thank you everybody for joining us today. And I think Rick has one or two other things to say about an upcoming webinar. So I'll turn it back to you, Rick. And I think I've got it on the slide up here someplace.
Okay.
Yeah, here we go.
All right. So Rick Miller, that's me. We'll present our next webinar in January on the 26th. And I'll be addressing human capital and earning power and implications for retirement. And we hope you'll join us then. You can register on the website, sensiblefinancial.com/webinars. And there's also an Eventbrite site. And let's see here. My technical support says that I can somehow communicate that to you, but I'm not quite sure. So perhaps they'll be able to paste it in the maybe they did paste it in the webinar already in the chat. Yes. So if you go to the chat, you can get the link for signing up immediately. We hope you'll join us. Thank you for being with us today. Have a good afternoon.